Hello and welcome to this EY's third video to discuss the IASB's IBOR reform project. I'm here with Tony Clifford, and together we will be sharing with you the highlights from the IASB's most recent discussions.
Hello. Now, by way of background, the IASB's project results from the decisions taken by global regulators after the financial crisis to replace interbank offered rates, or IBORs, with replacement benchmark interest rates, sometimes known as risk-free rates, or RFRs. And in 2018, the IASB started work to address the effects of IBOR reform on financial reporting.
The IASB has divided its work into two phases. Phase 1 to address issues affecting financial reporting in the period before the replacement of an existing interest rate benchmark with an RFR. And Phase 2 to focus on issues that affect financial reporting when an existing interest rate benchmark is replaced with an RFR. On the 26th of September 2019, the IASB completed Phase 1 with the publication of Interest Rate Benchmark Reform amendments to IFRS 9, IAS 39 and IFRS 7.
And at its October meeting, the IASB made progress in Phase 2 of its project. The IASB agreed solutions which address the Phase 2 issues associated with classification and measurement. Now, the solutions include clarifying how existing IFRS should be applied, adding some illustrative examples to existing standards, and amending IFRS where necessary.
And in November and December, the IASB will discuss Phase 2 issues associated with hedge accounting. The IASB plan to have finished their Phase 2 discussions by Q1 2020 and to publish an exposure draft soon after. You can find more information from EY on the IASB's project in IFRS Developments 144 and 145 and the Phase 1 amendments in IFRS Developments 152. These can be found online at www.ey.com/IFRS. At the October meeting, the first classification and measurement topic the IASB dealt with was determining whether a modification has occurred.
Yes, the reason the IASB started here is because IFRS does not define sufficiently precisely what is a modification of a financial instrument. In particular, if the methodology used to set an existing benchmark interest rates amended to meet new regulatory requirements, but no amendment is made to an instrument's contractual terms, it is not clear under IFRS today whether there has been a modification of that instrument.
The board discussed this issue and agreed that IFRS should be amended. They agreed to clarify the treatment.
Yes, the amendments will clarify that a modification is considered to have occurred if the contractual terms of a financial instrument remain unchanged, but the basis on which the contractual cash flows are set do change from what was expected when the financial instrument was first entered into. The example the board has in mind is the recent amendment of the way that Eonia is derived to now be ESTA plus 8.5 basis points. Changing how Eonia is derived is viewed by the IASB as a modification of the contract, even though the words in the contract have not themselves been amended.
The next topic the IASB discussed was how to determine whether a modification results in derecognition. For liabilities, IFRS 9 makes it clear that a substantial modification results in derecognition, and IFRIC, when it discussed the renegotiation of Greek government debt, believed that the same logic should be applied to assets. It is also clear that determination of whether a modification is substantial will often be a qualitative assessment. However, IFRS provides little guidance on when a modification would be assessed qualitatively as substantial.
It was noted at the October meeting that some modifications arise in the context of IBOR reform can be assessed qualitatively to be not substantial. This would cover a modification to replace a reference to IBOR with a reference to RFR, with no intention to transfer any fair value between the two parties to the contract. And the board was keen to stress that if any other terms of a contract are amended at the same time, these will need to be separately assessed to see if collectively all the changes are substantial. Now, the board considered whether to provide examples of such modifications, but they decided against it because it would risk widening the scope of the IBOR reform project, and doing so could delay finalisation of the Phase 2 amendments.
However, the IASB may add guidance in the basis for conclusions of the Phase 2 amendments. This will direct preparers towards existing guidance on identifying whether modifications are substantial. The next topic the IASB discussed related to how to account for modifications relating to IBOR reform when the instrument is not derecognised. The IASB agreed to include what they refer to as a practical expedient in IFRS 9. This will allow contractual changes or changes to cash flows that relate only to the reform to be treated as changes to a floating interest rate. This is therefore equivalent to a movement in a market rate of interest.
Yes, it is equivalent to applying what under IAS 39 we refer to as paragraph AG7 rather than AG8. And the benefit of this is it will avoid having to keep using the old effective interest rate based on IBOR, even once IBOR no longer exists. But it is important to stress that the practical expedient can only be used provided the transition from an IBOR benchmark rate to an RFR takes place on an economically equivalent basis, that is, with no value transfer having occurred. Now, as an aside, I hope that the IASB word this fairly carefully, since it's likely that most modifications, if not all, due to IBOR reform, will result in a small fair value transfer, a very small transfer, just because the spread between IBOR and RFRs on transition will normally be based on a look back over several days, rather than the market spread at the transition date.
In applying the practical expedient, an entity first identifies and accounts for modifications to the instrument which relate directly to IBOR reform. This is done by updating the effective interest rate, otherwise known as the EIR, without adjusting the carrying amount. Any other modifications to the financial instrument made at the same time, such as changing the credit spread or maturity date, are assessed, and if they are not substantial, the updated EIR should be used to recalculate the carrying amounts of the financial instrument, with any modification gain or loss recognised in profit or loss. Examples will be added to IFRS 9 for the types of modification that relate to IBOR reform, and the types of modification that would not. Also, an example will be added to demonstrate the order in which the different types of modifications should be reflected. The next topic that the IASB tackled was the accounting implications from the derecognition of a modified financial instrument in the context of IBOR reform.
That's right. Once it's been determined that a modification is substantial, the financial instrument will have been derecognised, and the board assess whether existing IFRS provides sufficient and useful information in this area in the context of IBOR reform.
One area considered was how the IFRS derecognition requirements work. When a financial instrument is derecognised, any difference between the carrying amount of the financial asset that has been derecognised and the consideration received is recognised in profit and loss. The IASB agreed that the IFRS requirements in this area are appropriate and no further guidance is needed. The next topic the IASB considered was if, as a result of derecognition due to a substantial modification, the entity's business model could be affected. The concern was whether the business model would continue to be appropriate if an asset is derecognised as a result of IBOR reform.
The IASB decided that such a change would not lead to a change in the entity's business model. This is because the business model is determined on the basis of whether cash flows will result from either collecting contractual cash flows or selling the financial assets, or both. Assuming the entity's way of managing the assets has not changed, the entity will not change its business model solely as a consequence of the derecognition event.
The board also considered whether for the solely payments of principal and interest, or SPPI assessment, if IBORs are replaced with, say, backward-looking term rates, there has been a concern that this would cause the new instruments to fail the SPPI assessment. If it failed the SPPI test, the instrument would not qualify to be recorded at amortised cost.
Now, an example of such an instrument included in the staff paper for the meeting was where the interest rate for the next 6 months is based on the accumulated overnight rate for the previous 6 months. Now, the IASB decided that the new instrument should, in this case, pass the SPPI assessment, provided that the interest rate continues to reflect the time value of money and does not reflect other risks and features. The The IASB also concluded that the principles in existing IFRS are sufficiently clear and that no further guidance is required. However, an example will be added to the standards to illustrate the guidance.
The board considered whether if an instrument is derecognised, if for the new instrument expected credit loss, or ECL, should be recognised on a 12-month or lifetime basis.
Now, the board noted that if as a result of the modification the terms of the instrument were changed such that the credit quality is either still continues to be good or has improved, a 12-month ECL would be appropriate. If, however, the instrument was deemed to be credit impaired at origination, the guidance for the purchase of credit impaired assets would apply. In either case, no assets should initially be in stage 2, and therefore none should be based on lifetime ECLs. And the board concluded that existing guidance in IFRS 9 is sufficient and no amendment or clarification is required on this issue.
The board also considered whether if a new financial liability included a fallback provision as to how it would be amended to an RFR, it would have to be separated as an embedded derivative. An example could be that on transition, a rate of 1 month LIBOR plus 100 basis points would be amended to the RFR plus 110 basis points.
Now, the IASB concluded that the current application and guidance in IFRS 9 is sufficiently clear for preparers to determine whether the features of the fallback would constitute an embedded derivative that would require separation. And this guidance includes the so-called double-double test.
So that covers what the IASB agreed at its October meeting. The next steps are for the IASB to consider at its November and December meetings the Phase 2 impacts for hedge accounting. Following that, in December and January, the other IFRS standards are due to be considered, plus any new issues identified, along with disclosures in relation to Phase 2.
Based on this timeline, the IASB could publish an exposure draft around the end of the first quarter of 2020. And for the Phase 1 exposure draft, the comment period was limited to 45 days, so if the same is done for the Phase 2 ED, the IASB is likely to publish the final Phase 2 amendments sometime early in quarter 3.
This timing is important because during 2020, entities may accelerate their plans to complete the transition from IBORs to RFRs, especially during the second half of the year. For entities' transition plans to progress, they will need the Phase 2 reliefs to have been finalised and available. Now we provide the EY view of how we see the steps taken by the IASB at its October meeting.
Well, the decisions taken should substantially resolve the various classification and measurement issues that will arise once financial instruments are amended to RFRs. However, we note that the decisions taken by the board so far are tentative and can only be considered final once the Phase 2 of the project is complete. However, I am pleased that most of the decisions involve a clarification of the standard rather than amendments. This should make it possible to apply much of what was considered before the standard is finalised.
However, we welcome the main proposed amendment of IFRS 9, that the introduction of the practical expedient that the transition from a floating IBOR to a floating RFR should, in the absence of any other factors, be treated as a change to a floating interest rate.
Yes, and although this will necessitate an amendment to IFRS and therefore can only be applied once the standard has been amended, if only limited numbers of instruments are amended before Phase 2 is finalised, hopefully the effect from such modifications may be immaterial. We're also pleased that the IASB is keeping the scope of the project reasonably narrow to avoid issues which could have wider implications and unintended consequences beyond those the IASB is trying to address. And this should also help allow the final amendments to be published sooner than might otherwise have been the case.
So that concludes this video. We hope you have found it useful. Should you need any more information, you can go to www.ey.com/IFRS. Thank you for watching.